This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris, and for the next hour here on News Radio 93.1 WFLA, also simulcasting over there to our friends on 540 AM, it is Dollars and Cents, where we help you make sense of all the different decisions that you have to face as you are thinking about your money. So this time of year, taxes are always a very popular topic, particularly with all of the changes that happened for this year. Probably one of the most sweeping changes that are happening for the tax return that you are preparing right now, generating a lot of questions. As I was walking out the door this morning at home, happened to catch on the TV a story about said changes, and the angle of the story was kind of interesting because it said that there was a uptick in the amount of false claims or shysters, I guess, for lack of a better word, that are out there scamming people, and ultimately people are succumbing to that because of this notion that there have been so many changes, and so consequently there's a lot of folks out there taking advantage of that, or more so than in years past, which is kind of interesting because the heart of these changes actually was to sort of simplify stuff. And so I kind of found that to be interesting in that this really is a simplification. When you go to a higher standard deduction, that eliminates the need that most people had, or the biggest need that most people had in terms of organizing their itemized deductions, things like medical expenses, mortgage interest, charitable deductions, unreimbursed employee expenses, all that stuff, which was really sort of the meat of what people spent their time with, or most of people spent their time with. All of that sort of disappears in the form of a much higher standard deduction. So it's estimated that approximately 70 to 80% of those people that were itemizing are not going to be. So that's a simpler thing. So I kind of find it interesting that that people are getting confused on, okay, well, what do I need to do now? Perhaps the most complicated of the changes, or the thing that you really kind of have to work through carefully, is this Section 199A deduction, which basically is the qualified business deduction. That's the one that allows you to take a deduction equal to 20%. And there's a lot of formulas and calculations that come into play, but it works out to be taking a deduction of 20% on your net profit. Again, if you are self-employed, or you're doing a Schedule C, or if you've got a side business of some kind, then I can understand where things would be a bit more complicated, particularly with that, because you certainly want to make sure that you get that right. It really depends upon what the nature of your business is. It depends upon how much total income you've got and how much W-2 income that you are paying yourself out. So a lot of different factors go into play on that piece of the equation. That's certainly where the complication comes into play, simply because you want to make sure that you're getting all of the deduction. But at the end of the day, there should be a little bit of a simplification. The going to the higher standard deduction obviously should simplify stuff. Even alternative minimum tax, which is that tax that lurks out there that says that you need to pay more in tax because you didn't pay enough under the traditional tax tables. Even that alternative minimum tax has changed quite a bit, and under the new tax laws, it's going to have much less of an impact on people, meaning that it's going to hit less and less people, simply because the amount at which that AMT is going to kick in, the amount of income in which that alternative minimum tax is going to kick in fact, jumped up pretty dramatically. And so with some of the changes as well with the itemized deductions, much less people are going to find that the AMT hits. So all in all, between the higher standard deduction, between the higher threshold on AMT, there's not really a complication here. It's really a simplification. Again, the only one is that qualified business income, that 20% deduction. That's where it kind of gets. You got to be real careful on that and make sure that you're taking full advantage of that option under the tax code. We've seen a number of returns already in the office as we're doing them that do qualify. So it's kind of a interesting way to pick up an additional deduction of 20% of your profit on your business. So certainly there's some significant implications on that. In terms of strategy, perhaps one of the strategies there's two different strategies that I think become more and more important to people in the conversation about taxes, and that really is the strategy known as bunching, which is basically putting more deductions in a single year. For example, if you give to your charity at the end of each year, perhaps you give at the beginning of the year and then at the end of the year, and in essence, from the charity's perspective, cash flow wise, that's sort of the same thing as December, but because you did it in January and December, then you get to bunch together those two contributions. In essence, you get to double it up. So that's certainly one strategy that bears looking at. Same thing with real estate taxes, right? I mean, we can pay here in Florida, you can pay your real estate taxes as early as November or as late as April. Well, if one year you pay them in November, and then the next year you pay them in January, February, March, then that means that you would be bunching them together in that same calendar year. They would be different tax years for the real estate tax payment, but the reality is that you would be bunched together within the same calendar year, and then thereby have two deductions that you would be able to write off. Of course, with that, you have to worry about the what is referred to as the SALT limitation, which is basically the limitation that kicks in if your deductions for state and local taxes are above $10,000. So be careful on the bunching on the real estate taxes, because then you could find out, well, wait a minute, now you're subject to that state and local tax exemption or the cap that's at $10,000. You hear people talk about SALT these days. What that refers to as that deduction for state and local taxes, CSALT. That's where that comes from. So that's the issue with bunching, and certainly a strategy to be thinking about, particularly under the new tax law. And then the other strategy is a pretty powerful one as well. It's one that's been around for a while, and it basically takes advantage of this notion of if I'm taking my required minimum distribution, so if I'm over age 70 and a half, and I'm taking a required minimum distribution on my IRAs, and sorry, folks that have beneficiary IRAs, this feature does not apply on a beneficiary IRA. It has to be your IRA that you're taking the required minimum distribution from. But if you take that required minimum distribution and send it directly to a charity, that's referred to as a qualified charitable distribution, and then that allows you to completely offset the income implication of taking that required minimum distribution right on the front page of your tax. Well, it's not on the front page of your tax return anymore because they changed it. It's on the back page of your tax return. But the point is that you do not have to itemize to be able to take advantage of that. So certainly some important things to be thinking about as it relates to your taxes. But at the end of the day, you really should find that they are a little bit simpler. If you've got a business, a Schedule C or some type of S corp, I mean, you got a business thing going on, yeah, okay, they're probably a little bit more complicated only because you want to make sure you get that 20% deduction. But vast majority should see it get a little bit easier in terms of the process. We're still seeing in the office where people are going through that exercise sort of as a one last check, if you will. And we're recommending to most of those folks, hey, that's great that you did this, but you really don't need to be doing it anymore. We'll circle back on that one in the year 2025 when that higher standard deduction actually is slated to disappear. So I guess stay tuned for that. In the meantime, we've got to take a break. We will go to the break. When we get back, we'll talk a little bit about the markets and some of the other mistakes that you can make with your money. And we will do that when we get back. We've also got open lines, so if you're sitting there trying to figure out your taxes and you've got questions, well, shoot, give us a call, 407-916-5400, toll free 1-866-916-5400, or you can send us an email. The email is my first name, Joel, Joel, at NelsonFinancialPlanning.com. That's how you can get in touch with us here on the program on this fabulous Sunday morning in Central Florida here on Dollars and Cents with Joel Garris, Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA 540 AM. We'll go to the phones. We got the 800 line. Hey, Dave. Good morning.
Good morning, Joel. I'm going to be turning 70 this year, and I'm just wondering, at 70 and a half, I know I have to take RMDs from my IRA.
Right.
I have a regular IRA, I have a Roth IRA, and I also have an inherited IRA, which I'm currently distributing from. But I was wondering, at the current level, I would like to move more money into my Roth, but I'm limited to $6,500 a year. Is there any way I can move money around to avoid some RMDs or unusual tax liability?
So, so when do you turn 70 and a half? Is it this calendar year?
No, it's next calendar year.
It's next calendar year. So are you still working and generating earned income, or no, are you fully retired?
My earned income is minimal. It's mostly, dividends, interest, and Social Security.
Okay, so it's not work income, if you will.
Right.
Okay.
Right.
So that alone prevents you from making contributions in to the various IRA or Roth accounts, combined with the fact that your age becomes the limitation on the IRA. So because you do have to have earned income in order to make contributions to either of those types of accounts. So the fact that you don't have earned income, that eliminates that option, as well as your age also becomes a factor in that analysis.
I won't be able to contribute to a Roth either?
You need to have earned income.
Okay.
Got to have work income.
All right.
If you don't have work, meaning like I went to a job and got a paycheck kind of thing. So if you don't have that, then you're not eligible to contribute to any of those.
All right.
And the Roth wouldn't really help you on your taxes. So you've got a beneficiary IRA, taking money out on that, which you're required to do. Now you're going to have to do your RMD. Dave, are you charitable minded? Do you have a favorite organization or church maybe or similar that that you are part of?
Yes, I do. I have a number of options, and I'm working out my estate now to figure out where to leave my legacy.
Okay, so that's good. That's a good little project for you. The biggest thing though that you can do that actually does result in direct tax savings is for your required minimum distribution. What you can do is you can actually have that required minimum distribution go as a qualified charitable distribution. And so what you would do is you would contact your IRA custodian, and you would say, hey, I want to make a donation of $500 to my church. I want to make $500 to Salvation Army. I want to do, the various amounts and the various organizations. And the IRA custodian will take that and send that check payable to the organization, and then that can go to you, so you can hand deliver it to your church or organization of choosing. And then that would allow you to completely offset the tax implications of that required minimum distribution. And here's the best part of it, Dave. Regardless of whether you itemize or not, you get to offset the tax implications of that required minimum distribution. So that's probably the most powerful approach that you've got, Dave, on that, is to sort of make your charitable contributions like you normally would, but instead of coming out of your checking account and writing the check and putting it in the plate, so to speak, have your IRA write the check and put that check in the plate, and then it's a complete right. Matter of fact, how you treat it, Dave, on your tax return is you report the gross amount that came out of your IRA, and then you subtract out the amount that went to charity, and you put that remaining amount, which would be the taxable amount of your required minimum distribution. And then what you have to do on your tax return, you have to put the initials QCD on it, and that gives the explanation to the IRS as to why you took that position on that distributed money.
So whatever I divert to a charity,
yes,
is dollar for dollar deduction against taxable income from the IRA, right?
Correct. Pretty best option you got. Yep.
Oh, all right. And there's no limit on that. I can do it as much as I want.
Do it up to the maximum amount of your required minimum distribution. Yep.
Okay. All right. Beautiful. Thanks a lot.
Yeah, that's a great feature, Dave. I mean, that's really powerful stuff, and it actually has been around for a few years. So that's definitely worth taking advantage of, and really the best option you got.
Thank you very much.
All right. Sounds good, Dave. We'll talk to you later. And then that does open up lines as well. So if you've got tax questions, it is that time of year. Or if you've just got other questions, it's always that time of year to be thinking about money and finances and all that stuff, because pretty much most of what we do has something to do with money at some point along the way. So those numbers, 407-916-5400. Toll free 1-866-916-5400. Email is, we'll check that during the break. Hard to check email and talk at the same time here on air. But the email is, the breaks are kind of long anyway. They run a bunch of ads. Folks at iHeartRadio, they need the money. So the email, Joel, Joel, at NelsonFinancialPlanning.com. I don't know if you saw this most recent Gallup survey. This is apparently a survey that they have been doing. The folks at Gallup have been conducting since August of 1977. So that is, help me with my math, that's 40 years, right? So the most recent survey results from January of 2019. So that was, well, I guess that can't say that's last month because we're already into March. I'm not sure where February went, but in the survey, 69% of adults surveyed believe that they will be financially better off in 1 year. 69% financially better off within 1 year. That, just for comparison purposes, is a mere 2 percentage points less than the all-time record of 71% that was recorded in March of 1998. Interestingly, if you think about back to 1998 and that time period, that was actually during a stretch for which the S&P 500 had produced annual returns of at least 20+% for the 5 previous consecutive years. So what's fascinating about that survey result, folks, is just how close that is. I mean, this is a survey that's been going on for 40 years. And you have the population of this country believing that they are going to be financially better off in 1 year, almost to the record high being set during a period of time where the markets were just absolutely going through. That was the big runoff to Y2K and that period of time in the 90s. But certainly interesting poll result that caught our eye. It says a lot about sort of what's going on in the economy, right? Because our economy is 70% based upon consumer spending. Clearly, the consumer out there is feeling better, certainly feeling better than the mainstream media would lead you to believe, right? I mean, I was fascinated by that. By that information, because certainly that's some interesting survey data. We'll slide back to the phones. We got a call from Jack in Windermere. Hey, Jack. Good morning. How are you?
Hey, great. Hey, I was going to follow up on the RMD question, but I agree with you on that poll. Except I think the economy is a lot stronger now than it was in '98, and I think the market's a lot healthier now because the underlying part of the market that dealt with the NASDAQ was just artificially high at that time because of all the dot-coms.
Yeah, you bet.
And I don't see that at all now. We've got real strong companies that are stronger than they ever were compared to back in '98. And so potentially, people are way better off than they would have been back then, with seeing hindsight. But I think anybody would say our companies are way stronger now than they were at that point in time. And meaning the market has got a better foundation.
I would agree with that, Jack. When you start to look at the data in terms of cash on hand and debt loads and things like that, it's a much stronger picture. And it's funny, the media just keeps hammering negative, and so I thought that Gallup poll data was kind of interesting. There's a lot of people out there, obviously, based upon the poll, that think that as well, Jack. Despite the water torture that the mainstream media gives us every day.
You're right. And what about, you mentioned cash on hand? I bet there's so much more cash now on hand that people have compared to 1998. I think that's a factor that's huge fuel for the market going forward.
Yeah, the cash levels are certainly pretty high relative to what they've been in the past. I mean, they've come down a little bit from their peaks of 2-3 years ago, but as people finally feel more comfortable and start to spend a little bit more and borrow a little bit more, but yeah, they're still at relative highs. That's for sure.
Oh yeah, that's great. If you have a minute,
Sure.
Question on the RMDs going directly to charitable contributions, isn't that pretty much a wash, though, if you itemize deductions? I mean, that comes in as income, you get a deduction, and for the people that itemize, wouldn't it really not be a benefit per se?
No, it would wash it out altogether. So when you take your let's say you got a required minimum distribution of $5,000, right? So you'd have to report the $5,000 as income on your taxes, okay? And under the new laws where you've got that much higher standard deduction, you're going to get that higher standard deduction, and the value of you being able to write off those itemized those charitable contributions sort of disappears with the higher standard deduction. So what the qualified charitable distribution does is it allows you to offset that $5,000 of income right on the front page. Well, it used to be the front page. Now it's the back page. But before you get to subtracting anything off of your total adjusted gross income, that would come off right off the top, if you will. So if you were itemizing in the past, Jack, and you had enough where you were getting that write-off on charity, you're right that this would have been almost sort of a wash, if you will. I have the income and then I have the deduction, true, but under the new rules where you've got that much higher standard deduction anyway, this is a great way to really boost up the value of that charitable contribution, if you will, because you kind of lose it, if you will, because of that higher standard deduction in today's world. But now if you use it as a qualified charitable distribution, then you don't even have to, it's an offset on the income side rather than an income and then a deduction. So it's got a little bit more power than it used to have.
That's if you're using the standard deduction and not itemizing.
Correct. But more and more people use the standard deduction under the new tax laws. But you're right. In the traditional form, if I was itemizing and if I took the money out and then I itemized, it would traditionally be a wash. This just sort of guarantees that you're going to get the wash, if you will.
Right. Okay. If you're lower income, lower deductions, then this is the way to do it. If you're higher income, higher deductions, then it wouldn't matter.
It wouldn't matter as much. I'm sure there are. Yes, I still think it's a pretty good way to guarantee that you wind up getting the offset. The other thing about it is when you look at the calculation for determining the taxable amount of your Social Security, that's where it also comes into play as well, which does have some benefits, particularly if you're in retired and making under probably 60 or 70,000. That's where it could also come into play, where it would, in essence, not push your Social Security be as taxable as it might otherwise be.
Interesting. All right, that's great. Great to hear your comments on the optimism survey. I think, like you said, it's probably greatly depressed because of all the negative comments in the market and in the media against Trump and what he's trying to do. It obscures the real picture of what's happening right now and the strength of the economy.
Yeah, I was surprised at how strong that Gallup poll survey was. Interesting stuff indeed. Jax, thanks so much for calling into the program. We'll slide to our break here at the bottom half of the hour, and that does free up some lines as well. So 407-916-5400, toll free 1-866-916-5400, and then we'll check the email during the break. It's Joel, Joel, at NelsonFinancialPlanning.com. We'll be back after these messages here on Dollars and Cents News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Also simulcasting over there to our friends on 540 AM as well. My name is Joel Garris of Nelson Financial Planning. And another little addendum to the Gallup survey results that we were talking about in the last break. The other thing, of course, that has happened so far this year is the stock market. Something that you only hear about in the mainstream media when it's going down. You don't really hear much about it when it's going up. I always wonder why that is, except at the end of the day, I know why that is. After all, bad news always sells better than good. My friend Bud Hedinger told me that many years ago, and that's where we're at. So you may not have heard, but the market for the first 2 months of the year, January and February, off to its best start in nearly 30 years. Of course, that is on the heels of one of the worst Decembers in several decades as well. Just goes to the very nature of the volatility that is inherent in the stock market. One of the biggest reasons why you simply want to stay consistent. And unfortunately, we saw in December a record outflow across this country of investors pulling their money out of equities and equity-based mutual funds. Certainly not a particularly good time to do that, but many did, and unfortunately, that goes directly to undermining their return over time. That is for sure probably one of the biggest reasons why the market has bounced up as much as it did is very simply in November and December, it probably was overshooting. Well, not probably. I guess it clearly was, given the performance of the market in January and February. The announcement by the Fed about interest rates certainly helped, but it does give you pause to the kinds of mistakes that people make. And we always talk about the primary mistake that people make with their money, and that is going to cash at the wrong time. But there's a host of other mistakes that people make simultaneously with that. And that really has to deal with the types of investments that they wind up chasing as they're looking for that other magic formula. Because at the end of the day, while consistency sounds being trite and too easy, when you actually try and employ that, it's in fact one of the hardest things to do, as we saw based upon just simply investor behavior and performance of late. So a lot of the issues that happen don't just involve going to cash. They often get further compounded by getting detracted by the other options out there that are always floated out anytime the market goes down, as these are alternatives, and these are alternatives that ultimately are going to behave so much better than what you just got out of. The problem is that that category of investments is usually pretty weak in terms of its performance and how they actually work. One of the most popular of those, of course, is gold, right? Everybody loves to talk about gold, especially when fear is at the highest. And I find it fascinating the fact that if you look at the performance of gold over time, it's actually been a far more volatile asset class to own than simply owning the broad base market. Gold has no earnings. Gold has, it's a rock. It hasn't changed since the time of Christ, and it won't going forward. But yet there seems to be this attraction whenever fear creeps in to the market. And then the other part of that, which is always even more fascinating, is you hear these people say, oh, well, we're going to go back to the gold standard, and the dollar is ultimately going to disappear. Okay, that again, we've certainly talked about that in prior programs, but when you've got over 70% of all transactions worldwide denominated in the U.S. dollar, that's not going to happen in our lifetime. That's very, very clear. The breadth and the depth of the U.S. dollar is mind-boggling, to say the least. What's even more fascinating is when you see the full-page ads that run in the Orlando Sentinel. And let me get this straight. So they're going to charge you 10% when you buy the gold, right? And then, well, they don't say that in the ads, but that's what they do. That's sort of the going rate, 10%. And then when you want to sell the gold, they're going to charge you another 10%. So to be clear, you've got to make at least 20% on that investment before you even clear your cost. Didn't think about that part, did you? Okay. What's even more fascinating is they'll swap that gold. They'll sell you gold in exchange for U.S. dollars. I wonder why they're doing that. Oh, because that's how they make money. And at the end of the day, the gold buyer and seller, well, he's doing it in dollars as well. He wants those dollars. That's why he's selling it to you in dollars. We've got some more thoughts on this topic, but we'll take a break. And we've got open lines during the break at 407-916-5400. Toll free 1-866-916-5400. We'll be back here on Dollars and Cents after these messages on 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1. This is Joel Garris of Nelson Financial Planning. Talking a little bit more about taxes than normal, but I guess given the time of year, that makes sense to do that. Some good conversations with a couple of callers earlier in the program today. Still room to squeeze another caller in there if there's one out there. 407-916-5400. Toll free 866-916-5400. In the meantime, we started the conversation before the last break of some of the other mistakes, or how people sort of compound their mistake when they move to cash in an overreaction to what the media is telling them, or what is going on in the market. There's a host of things that people find themselves getting involved in, one of which is gold, a far more volatile and a much higher cost to owning than people realize. But boy, they love that gold, especially when fear goes a little bit higher. Another one, which is probably one that we rail against the most on this program over the course of the past 30 plus years that the program's been on, and that's these annuities, these guarantees. I did a show. What was it, last week or the week before? Forget which really broke down even some of the more popular ones, which are these guaranteed retirement income benefits. When you actually run the numbers, even these 5.5% guaranteed income things, or 5% or 6%, whatever the heck they're offering, when you actually sit down and put pen to paper and go through the numbers and understand the underlying expenses, you wind up with rates of return that are around 1.5%. That's the guarantee that you're actually getting. And when you stop and think about that, yeah, that's the reality, because given where interest rates are, the insurance company is not actually paying you 5-6%. That's not how that works. But many people succumb to that. Many people find themselves in these products that have very high cost and very long surrender schedules. Again, ways that you can compound your investment mistakes beyond just simply moving out of cash when the market goes down is what you then move into once you've done that. And that's where the strategies can really come off the rails, whether it be gold, whether it be annuities. There's also popularity among alternative investments, which sound really cool, but at the end of the day, have like no transparency, ridiculously high costs, much greater risk than what you're taking with a diversified portfolio. Oftentimes complete illiquidity on it, meaning that if you want the money out, you got to find somebody to either buy what you own or wait forever until the investment itself closes down. Beware of these alternative investments that are out there. They sound really cool, but at the end of the day, they really are some pretty high commission products that are basically based upon the ability of that person's crystal ball to do as well as they are doing, and that becomes very, very difficult. Another strategy that becomes also very popular, which I just don't understand this one at all, and that is because this one has like the highest risk out of anything you could possibly imagine, and that's simply trading options or trading futures. Those types of strategies are basically you're just gambling at the end of the day. You're just making bets based upon whether the price of a particular stock is going to go up or down. You have to be right on so many different levels whenever you're doing an options or a futures strategy. That just amazes me how somebody could get nervous about the market and then and then proceed to say, well, I'm going to go do this strategy because this is a safer or better strategy. The problem is that most of these alternative strategies, in fact, have much higher risk, much higher volatility. Certainly the case with gold, certainly the case with alternative investments, and certainly the case with options and futures. But those are the things that we find that people go into, or some of the things that people go into that at the end of the day are simply way more risk than folks realize. So don't make that mistake with your money. Don't compound the error of moving out of the market when the market is down. Don't compound the error by then shifting into something that has a much higher level of volatility, much higher cost structure. I'm reminded of a conversation I had a couple of months ago where a diversified portfolio, obviously in December, went down quite a bit, and folks were rightfully concerned about that. And so after we have that conversation about kind of the inherent volatility of the market and kind of how that all plays out, and in fact quite a normal part of being an investor, the last question they asked me is, well, here's what we're thinking about doing instead. We're thinking about going out and buying pot stocks. And I'm like, okay, did anything that I just said get listened to at all? Because if you're concerned about the volatility in the broad-based market with companies that make the goods, the products, the services that the world uses every day, that are big, giant companies, and you think the better alternative is to go into a highly unregulated, basically a crime under federal law to work with, that's your better choice. It amazes me how people can succumb to those types of other options that simply just get promoted, and nobody bothers to take the time to look at the actual return over time. Or in the case of those annuities where you get to participate in the market, or you get a guaranteed income stream, to actually sit down and look at the expenses and look at how much is getting paid out over the course of time, and then simply calculating rate of return. If you missed that show from a week or two ago, really encourage you to listen to that show where we really break down the math on these guaranteed retirement income benefits. And ultimately, the pretty clear conclusion is that your rate of return over time on those is 1 to 1.5%. Again, because it's guaranteed, you're not really going to get, at the end of the day, much more than what you would on a traditional guaranteed savings account, an FDIC-insured savings account. If you think the insurance company has some magic formula that allows them to guarantee effectively a much higher actual investment return, please think again, because they don't. All they're doing is marketing and spinning and this benefit, that benefit, that at the end of the day doesn't add up. And certainly the numbers bear that out. So don't compound your mistake. If you're in that group of people who overreacted in November and December, don't compound your mistake by then proceeding to chase other sounding investments that at the end of the day have much higher cost structure and much higher level of volatility than you may be aware of. So some things to think about this morning for y'all. So anyway, we got to wrap it up because we're out of time. So we will do that. Hope everybody has a good rest of Sunday, and we will be back next week here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.